the last 6 months have been characterised by probably the lowest amount of turnover and changes in the portfolio that we've seen over the 6-odd-year lifetime of the trust, for the simple reason that we've had this incredibly unusual market dynamic where small and mid-cap stocks have underperformed larger, more kind of benchmark weighted things, and because of the general geopolitical macroeconomic uncertainty in the world at large at the moment, people have been very conservative in their asset allocation. So you've generally seen a kind of risk-off dynamic. People are eschewing growth and moving toward value and all those sorts of things. Now that's been a very challenging period for us because we're very US growth, mid-cap healthcare oriented, and consequently our performance over the last, I'd say, 15 months has been below where we would have expected it to be. But the interesting thing there is if you look at the fundamentals of healthcare, this is a very long duration, demographically driven sector in terms of its drivers. There's no reason to think that the environment for healthcare has changed. It's not a consumer discretionary activity. The healthcare market grows during recessions or periods of economic boom. It's all driven by population dynamics rather than the economy at large. So we've had a situation where there's this really classical disconnect between market sentiment and the reality of what's happening with the companies in terms of progress on business objectives, delivering revenue growth, delivering profit growth, and so on and so forth. So we've spent most of the last 6 to 9 months really just buying more and more of the companies that we already own, because we're convinced we hold the right ordinances to benefit strongly from a much more rational and longer term thought process from investors regarding where they want to be positioned in a world where I think consumer-led growth is going to be harder to find. The reality is that healthcare is somewhere that's going to keep chugging along, delivering robust growth because of those demographic trends that drive demand. So recent's an interesting question as well. Everything depends on your time frame. So the early start of 2023 has been very strong for us. The 9 months of 2022 was sort of from the end of Q1 onwards was very volatile and mixed. We underperformed the benchmark and the wider market over the course of calendar 2022. Delivering a negative absolute return for the first time in the trust life. We're still, I think, the best performing healthcare investment trust since our inception back in late 2016. But we can't be happy with how things went. But the interesting thing to my mind there is if we think about valuation upside for our portfolio, at the end of 2021, we were looking at an expectation of our portfolio having near-term growth potential in value terms of about 30%. And obviously that didn't happen. The portfolio went backwards. But as I said previously, nothing's really changed. So what's happened is that actually that valuation upside has got significantly larger. And where I think we are right now as we move into 2023, we are, the big debate is whether or not we're going to have a recession in developed economies, and then how intensive that recession is going to be, how long it's going to last, how long this interest rate cycle is going to go on. So if you're a growth-oriented investor, you're probably sitting there thinking, where can I be confident that I'm going to see growth? And I think the reason that we've had a good start to the early part of 2023 is if you're rational and dispassionate, you're going to look across the universe of opportunities and you're going to say, well, other than things like green tech, clean tech, the energy transition, where do I have that really long-term visibility that I'm going to see continued demand for products and services regardless of the economic outlook? And healthcare is the logical answer to that conclusion. So then you're going to look for the cheapest growth in healthcare, and what you'll find if you look at indices, like the Russell 2000 healthcare index in the US, for example, whereas a lot of indices have bounced in the latter part of 2022, and markets don't necessarily look cheap relative to history. If you look at small and mid cap, it looks cheaper, and if you look at small and mid cap healthcare, it looks cheaper again. So I think we're nicely positioned in a sweet spot in terms of relative valuation and growth outlook. And I think what we've seen in the early part of 2023 is some recognition of that reality and a consequential re-rating of many of the companies in our portfolio. and obviously we hope that will continue in the months to come. So we have a general tendency to with all of our investments, we take a long-term view. So we're looking to be 3, 5, 7 year holders of these companies, and we try and plot out not just we don't just buy companies we think are cheap today. We buy companies we think have the opportunity to accrete significant value over time, and we have this 15% annualized internal hurdle rate that we use for our investments. So we kind of map out the journey that we think the stock should be on over that period of time. And generally speaking, when things do better than we think they should do in the short term, we take a bit of profit and then we recycle that into the ones that have lagged in terms of relative performance. So the biggest characteristics of our portfolio evolving over the latter part of 2022 was really kind of selling the winners. And if you look at what those winners were, it was quite interesting, and I think tells you a lot about broad market sentiment. So the best performing areas of healthcare last year were healthcare distributors, basically wholesalers, logistics companies. They don't grow very fast, they don't make very big margins, but they're incredibly boring and stable. And then it was managed care companies, so US health insurers, again, generally boring and stable, really driven by overall employment in the US, which has remained robust. And they've had a tailwind from interest rates rising because they have to hold bonds, and also because actually the residual of the COVID pandemic is still that people aren't consuming as much elective healthcare, so hips and knees and things like that, as they were pre-COVID. So healthcare is still recovering, getting back up to trend post-COVID. So those things were in a sweet spot. They've achieved a multi-year valuation highs, and that's where a lot of generalists, for want of a better word, have been hiding during the economic uncertainty, particularly in the US. We had some exposure to managed care and some exposure to larger pharma. We've generally got rid of that or reduced that significantly over the past 6 months as valuations have become more and more not stretched but fuller, if you like, and therefore the risk reward of continuing to own them has gone down, and we've put that into areas where we think there's significant upside. So that's generally been in some tools, for example, some healthcare services, and around things like healthcare IT and healthcare technology, where because these are very growthy sectors, they were hit quite hard in the rotation away from growth that happened in the early part of 2022. So we've been selling the winners and buying the losers is within our own portfolio is kind of the simple answer. Right, let's illustrate this with two stocks. The first is a biotechnology stock called Sarepta Therapeutics. So Sarepta is a very focused company. It specializes in drugs to help manage a debilitating genetic disease called Duchenne muscular dystrophy, which is a very upsetting condition that results in loss of movement and early death in children who are afflicted with the disease. And Sarepta makes these drugs that help to extend quality of life and lifespan through correcting some of the genetic mutations that underpin the disease. But the real holy grail of treating these sorts of diseases is to try and use either gene editing or gene therapy to effectively introduce genetic changes that enable people to overcome genetic diseases. And we've seen this beginning to emerge in some areas like hemophilia, for example. But it gets more complicated when you start talking about things that affect the whole body and more complex systems like muscles. So Sarepta is incredibly interesting because it has spent a long time working on how to do gene therapy in DMD, and it's close to an FDA approval decision. We expect that to happen in the first half of 2023, but this will usher in a whole new era, because this is really about the validation of a technology and the demonstration of how you can consistently dose a product and deliver a product that gives consistent results and all these things. It's not just about does the drug work, but can you produce these things at scale? Can you serve the needs of multiple patients in such a complex disease, and so on and so forth? So it really is a stock, in our view, where the core technology that the company's developed, and it spent literally billions of dollars on developing the manufacturing side of this, the quality control side, as well as running all of the trials. It kind of opens a fascinating new area of medicine, in our opinion. So that's a stock that we see both short-term potential for very meaningful increase in the share price, but then also a sustained period of significantly above market growth that could lead to very high revenue. So this is a company, for example, has $800-900 million of revenues today, is spending more than that on R&D, so it's not effectively making any money. Its internal expectations are that it could be a $10 billion revenue company by 2030. And that is certainly not what we're forecasting in our model, but it doesn't sound outlandish relative to the potential of the pipeline if all of the gene therapy stuff comes to fruition. So this is a stock that you can imagine could double in relatively short order and then continue to compound significantly over years to come. There's a classic example of a innovative technology bringing significant benefits to society by addressing a whole raft of severe medical conditions, giving better options to obviously caregivers to treat patients, better quality of life to patients, and then obviously benefits to society as a whole, because these people can hopefully go on to lead lives where they can be productive members of society. So that would be the first example. The second example is somewhat different, and our whole thesis is really about the transformation of the healthcare system to make it work better. And what does that mean in practical terms? It means lots of things, but primarily it means we need to find cheaper ways to treat people. And one of the fundamental problems with how healthcare works is putting people in hospitals. So hospitals are horrible places no one wants to go to. They're incredibly expensive and full of sick people with communicable diseases. If you could possibly avoid going to one, the world would be a better place. And leaving aside people who are having surgery, if you're burdened with chronic diseases, why should you go to hospital? If you're already suffering the challenges of having chemotherapy because you've got cancer, for example, why do you have to schlep to a hospital when your immune system's compromised and you're tired all the time to receive your chemotherapy? Why doesn't someone come and give you that chemotherapy at home? Why don't you have your follow-up treatments at home? Why don't people come and visit you to take blood and measure your blood pressure and all these sorts of things? So the transformation to care in the home is one of the key things that we think will aid the transformation of the healthcare system. There's loads of evidence that shows that psychologically and thus medically people do much better when they're treated at home, not surprisingly. And it also saves significant amounts of money because it frees up hospital resources for surgery and other things. Part of the reason we've got these huge waiting lists here in the UK at the moment is because beds are full of people who shouldn't be in hospital, and that's a social care problem. But if you could limit the amount of time people needed to be in hospital, you can transform how the healthcare system works. So we have several companies in the portfolio that address this transition of site of care from the institutional setting toward the home. But the one I would highlight is a company called Option Care Health. And what they basically do is they manage the treatment of chronic medical conditions that require infused drugs. So things that you need a drip and a line into your arm, possibly for several hours as you receive an immunological therapy for cancer treatment or for a disease like rheumatoid arthritis or something like that. And the way Option works is they organize everything from the billing of your insurance company, the delivery of the drugs, someone coming around to your house sets you up with your infusion system and manages it all for you and then takes everything away. So if you're having that monthly treatment, you're no longer going to the hospital, you're no longer spending hours at the hospital and then having to come home. You're in your home, you're having treatment at home, you can potentially be working while this is going on or doing something that's useful, being with your family. And the doctors still get all of the relevant information about the patient, how they're doing, the drugs, the oversight of everything that's going on. And it's all seamlessly done in a paperless process in the background because they've organised links with all the key hospitals and all the key payers and insurers and so on and so forth. So it's a classic example of how you can take something that sounds very, very simple, giving people drugs at home, and actually make it work and make it practical from an organisational and administrative perspective. So I think the outlook for healthcare utilisation is very robust and stands apart from other areas of the economy for the simple reason that it's not a discretionary activity. Hopefully nobody ever wants to be ill. It's not a choice that they make. It's something that happens to us all, and we seek treatment when we need it. So I think resilience of demand is very clear to everybody. I think as well, you don't have to look very far to see all of the signs of tremendous strain in the healthcare system. In the UK, this debate is an incredibly politicised one. Labour says it's lack of investment, the Tories say it's not, and that the healthcare system gets more money every year, which is true. It gets a greater percentage of GDP, which is also true. So what's the answer? I think you need to take the politics out of it to some extent, because the challenges we face are shared by most developed economies, and the excess death, interestingly, that everybody's talking about at the moment, that is a phenomenon in the UK, is also being seen in the US and Spain and Italy and Germany, etc. And maybe it's something to do with the hangover from COVID. There are lots of possible explanations for that, but these are significant challenges that are not going away, and no amount of pay rises for doctors or nurses to make the job seem more attractive is going to enable them to train enough people in enough time to address the chronic labour shortages we have. So the other aspect of our investment thesis that seems undeniable is the healthcare system absolutely has to change, otherwise it will cease to function, because it's going to run out of people to meet the demand that is required. So again, when I think about that element of the outlook in the long term, I feel very, very relaxed that we own exposure to the right trends, and that in the fullness of time we will be handsomely rewarded for the approach that we have taken. I think in the shorter term, things are clearly more complicated. The economic and geopolitical outlook remains unstable because of Ukraine, because of what's going on in China. Is COVID going to burn out really quickly there? And there's going to be a massive hockey stick recovery in the second half of 2023? Or are we going to have multiple waves like we've seen everywhere else? And this is going to be a persistent drag on not just global demand, because China is a big market for people, but also global supply, because China makes a lot of stuff for the rest of us. So there are lots and lots of shorter term challenges. And I think that does make equities as an investment class, challenging for lots of investors. But again, our thought on this is a relatively simplistic one, but I think one that seems valid, which is nobody can know when these inflection points are going to happen here. When is the geopolitical overhang with Russia and Ukraine going to end? When's it going to be apparent whether or not China is going to hockey stick out the COVID situation? So the logical thing to our mind is to be invested in the things that will benefit from the normalization of everything, and be in those now, so that as and when it happens, you are appropriately positioned. Because the problem with sitting on the sidelines, of course, is that you can sit on the sidelines for too long and then you can miss things. So we feel very, very relaxed about the medium term outlook. I think the shorter term outlook is more challenging, but the relative underperformance of small mid-cap healthcare versus healthcare broadly and the market broadly also suggests actually we should be, in a rational world, somewhere near the front of the queue for something of a shorter term re-rating. So with all of those factors in mind, I feel quietly optimistic about the outlook, and I think 2023 should be a positive year overall.